Let's start. Hi, everyone, and welcome to our November No-Fluff Homebuyer class. My name is Angel, and I'm part of the team supporting Team Reba. We're excited to have you join us today as we walk through the essential, no nonsense, real world steps to becoming a successful homebuyer without the fluff. We're joined by two amazing experts who will guide you through the real estate and lending side of the home buying journey. Reba Haas, Team Reba CEO and Realtor, Joanna Liao, Livewell Home Lending Mortgage Broker. And before we dive into the presentation, let's run through a quick Zoom tech check to help us stay engaged and interactive. So if you have any questions during today's class, feel free to use the Q&A button. It's right at the bottom of your screen now. And simply click the Q&A icon and type in your question. And if you can, let us know whether your question is for Reba, Joanna, or both of them, and we'll answer those live after both presentations are finished. Now let's get into the good stuff. Joanna, we'll start with you. Please walk us through the lending process from pre-approval to programs, payments, and how buyers can prepare financially for today's market.
All right, great. I will share my screen. And just let me know when you can see it. Hold on a minute. All righty. Okay, great. Can everybody see my screen?
Yep.
Okay, great. All right, so my name is Joanna Liao with Livewell Home Lending, and I am a mortgage broker, and Livewell is a local mortgage business here in Seattle. I'm really glad to be here this evening, and first, just a big thank you to Reba and her team for putting this presentation together. And I'm just really excited to share some valuable information that I think will be helpful on this real estate journey. So before I get started, just a little bit about myself and our company. I work with my business partner and sister Sandy, and together our loan team brings over 20 years of combined mortgage experience. We're also able to originate loans in all states, which is a really great benefit if you're moving across state lines or have friends and family buying homes around the country. We can also help with that. Okay, so just a little bit about how our company approaches our clients. As a boutique small business, we take a client for life approach. We don't just help you purchase at home and then we just disappear. You can call us anytime with mortgage questions, even years after your loan closes. We also proactively monitor your mortgage over time, and we reach out if you become eligible for a rate reduction or monthly savings. Each year, we provide a customized annual home report along with a follow-up consultation to check in on how things are going, whether you're thinking about moving up, downsizing, maybe purchasing an investment, tapping into your equity, consolidating debt, all of those things. We truly view our clients as long-term relationships, and our goal is to be your mortgage resource for life. Okay, so just to keep things interactive, I'm going to start with a quick poll. How many of you here are first-time home buyers, or how many have already own a home? So let me see. Angel, are you able to see kind of hands up?
I own.
Okay, there we go. I own a home. Yeah. Perfect. Okay. So some of the information that I'm covering tonight will be especially helpful for first-time home buyers, but will also be a really great refresher for some of those of you who have gone through the mortgage process, but it's been a while. And then after that, I'm going to talk a little bit more specifically about certain loan programs. And the folks that signed up today, it's a little bit of a mixed crowd in terms of different loan programs that I might address. So I'll touch on each of these things a little bit, but if you have more questions about your specific scenario, we can definitely book a time privately later as well. All right, so here's a quick overview of what I'm going to be talking about. We're going to start with a brief look at the current market and where interest rates are now. Then I'll kind of walk you through a review of what the mortgage process looks like from beginning to finish. Then we'll cover some credit and fraud issues that are especially relevant today. You've probably noticed an increase in phishing and scam calls lately. That's not by accident, and it's something we all need to be vigilant about, especially when we're dealing with mortgage financing. After that, we'll go over some loan programs that have been particularly helpful in this current real estate environment, and then look at some real life scenarios, and then we'll wrap up with time for questions afterwards. Okay, so the economy and interest rates. The US economy is still growing, but things are moving a little bit more slowly, and there's a lot more uncertainty than we've seen in the recent years. Experts expect growth to cool down next year as trade challenges, changes in government policies, and tighter budgets have put pressure on both businesses and consumers. The job market remains steady, although hiring has slowed, and inflation is still a little bit higher than what the Fed would like, which makes them cautious about making big moves. The recent government shutdown has also slowed the release of key economic data, making it harder for the Fed to get a clear, real-time picture of the economy. And because of this, a rate cut in December is possible, but it's far from guaranteed. That being said, it can still be a really great time to buy a home. Mortgage rates are currently in the mid to low 6% range, which is lower than the 7 to 8% we saw last year. And while they're not at the historic lows of the pandemic, they are still very manageable for buyers who are pre-approved and know their budget. For anyone ready to make a move, being organized and pre-approved can help you take advantage of today's market and get into a home without waiting for rates to drop further. Okay, so as of early November 2025, 30-year mortgage rates are landing roughly in the low sixes, around 6.2, 6.3%. Earlier this year, back in March, they were closer to 6.7, 6.8. So they've come down a bit, but overall, it's been fairly steady in the sixes. But to put that into perspective, here's a quick look at the bigger picture. In the 1980s, rates were sky high, think 16%. In the 90s, they were mostly, 8 to 9% range. In the 2000s, they settled around the 5 to 6% range. And then during the pandemic in 2020 and 2021, rates dropped to that historic low around 3%. But that was because of the extraordinary nature of the pandemic and something we're probably not going to go back to anytime soon. So the bottom line is today's rates might feel a little bit high, close compared to a couple of years ago, but they're actually nowhere near the extremes of the past. And mid 6% rates are actually pretty normal when we look at it through history. All right, so take a look at this poll from last year. It shows how many home buyers have been sitting on the sidelines for the past 2 or 3 years waiting for the interest rates to drop. And a lot of people say they're going to jump back in once rates hit that magic 5% range. So what happens then? It's going to be a lot more competition, more buyers writing offers, more bidding wars, and higher prices. And like Warren Buffett says, you buy when others are fearful. So if you're thinking about buying, sometimes it can actually be smarter to buy now while others are on the sidelines waiting, and then refinance later when the rates come down. That strategy can save you more money in the long run and help you avoid that rush when everybody else decides to jump back into the market. All right, so let's walk through what that home buying process looks like, especially for first-time buyers. And even if you purchased a house in the past, this is a helpful refresher. So I like to use this overview because it shows the big picture, the steps from start to finish. So the first step is obviously preparing your finances. This means taking a careful look at what you can afford, organizing your budget, and making sure your credit is in great shape. These steps are essential to make sure you're ready to secure mortgage financing and move through that process confidently. Next is a pre-approval process with me, and I'll go through that part in detail on the next slide. But that's when we'll go through all your financial paperwork and your mortgage options. Then comes the fun part, shopping for your home. You'll work with Reba on creating a wish list, think through what's most important to you, location, size, style, etc. You'll compare pros and cons, figure out your budget, and focus on homes that fit your needs. Being prepared ahead of time helps you avoid looking at houses outside of your price range. Once you find the home you want, the next step is making the offer. This is where being prepared pays off. A solid offer that shows the seller you're serious, you're ready to move forward, and you fully understand the financial side of buying a home. After your offer is accepted, we move into the loan and closing process. That includes your inspection, ordering the appraisal, completing underwriting, and then finalizing the loan paperwork. Once everything is approved, you get your keys. So typically the loan process takes about 30 days, even though it can vary depending on the situation. All right, so let's dive a little bit deeper into the pre-approval, which is a crucial step, especially for first-time home buyers. So a pre-approval is essentially a lender's way of determining how much you can borrow and what loan options make sense for your situation. So pre-approval mainly looks at four main factors: your income and employment, the debt you're carrying, your down payment, and then your credit score. So all of these factors together determine your borrowing power and gives you a realistic budget to work with when you're shopping for a home. Now, I've seen buyers, they think they have an idea of what they qualify for. They jump straight into looking at houses without the proper pre-approval, and it often leads to frustration. You might fall in love with a house that's outside your budget and then discover you're not in a position to make a strong offer. A pre-approval prevents that, and the process starts with a conversation with me. We talk about your home buying goals, your monthly budget. I'll review all of your financial documentation and then provide you with a pre-approval number. Along with that, I'll show you different loan options and monthly payment scenarios that work for your situation. Having this approval allows you to shop for homes confidently. You'll know exactly what you can afford, and when you're ready to make the offer, the seller can feel confident that your pre-approval is verified. That means you're truly qualified to purchase the home, and it gives you a competitive edge in today's market. All right, so another quick poll. Does anyone know what the minimum down payment you can put on a home purchase is? I'm fairly sure Reba knows this.
I was going to say, I'm disqualified from answering.
Okay, All right. Well, I did not know this before I became a lender, so I will go over this, and the answer is it's a little tricky. So I kind of had a little twist here. So the answer is our favorite answer in the world. It depends, right? So it depends on the type of loan. So a conventional loan, the minimum down payment is 3%. On an FHA loan, it's 3.5%. On USDA loans, which is like loans for rural areas or farmland, it can be 0. And also for VA loans, it's also 0. So there are even some down payment assistance programs that allow 0% down payment. So this is knowledge that most people don't know. Most people think you have to put 20% down for a home. And that's only true if you want to avoid mortgage insurance. But the reality is you can put down much less than 20%, and most home buyers actually do. And it helps them get into a home a little bit sooner. All right, next I'm going to touch on safety. That this is a very relevant topic now, identity theft. I tell all my clients this: one of the best ways you can protect yourself is to freeze your credit. So a credit freeze blocks anyone, including identity thieves, from opening new accounts in your name. It doesn't affect your credit score, and you can lift it anytime you need to apply for credit, say for a mortgage or purchasing a car, etc. It's free and it's easy. You just need to contact the 3 major credit bureaus: Equifax, Experian, and TransUnion. And each of them lets you set up and manage a freeze online or by phone in just a few minutes. And I really encourage everyone to do this. Identity theft can be messy, time-consuming, and stressful, and freezing your credit is a simple, painless way to protect yourself. Okay, another way to protect yourself from phishing and like a barrage of sales calls, especially when your credit is pulled for things like a car or mortgage shopping, is to opt out of pre-screened credit offers. So unfortunately, credit bureaus sell your information when your credit is pulled. And I actually had a client recently who received over 100 calls and texts within a span of 3 to 4 hours after her credit was pulled, which is really crazy. So you can do this for free at optoutprescreen.com. And that's an official website run by the credit bureaus. And you can choose to opt out for 5 years or even permanently. And if you prefer, there's a phone number, you could do that as well. But this is also a safe and quick way of just guarding your identity and avoiding that barrage of calls. Okay, so in today's market, well-priced homes are still selling quickly and it's competitive. So it's important to be fully prepared to write a strong offer. So one way we do that is by securing a fully vetted pre-approval. And that means I've already reviewed all your paperwork, verified all your financials, and completed an initial underwrite. And this is particularly helpful with self-employed borrowers whose documentation can take a little bit longer to review. Once that's done, basically you're ready to go shopping. We just need to wait for you to find the property you want, do the inspection, complete the appraisal, and then we can close very quickly, sometimes in as little as 10 to 14 days. Being fully approved like this shows sellers that you're serious and you're ready to close fast. Another advantage of working with a local mortgage company like ours is our reputation and relationships in the community. So when you make an offer, I always call the listing agent directly to let them know we're going to stay on top of everything. We're going to communicate clearly. We've already reviewed everything, and we're going to work towards a quick closing. Also, when our clients are okay with it, sometimes we'll share details with the listing agent about our clients, that they love the home or they know the neighborhood well and have the kids in the school district, etc. So giving that borrower story can also help your offer stand out. And I've had, offers that may not be in the highest price, but the sellers liked knowing a little bit about who's buying the home, and they were able to win that home. So all of these are steps that help you win in a competitive market and also help protect your earnest money during the transaction. Okay, now I'm going to talk a little bit about some specialty loan programs that many of my clients have been using in today's market. These include bridge gap loans, bank statement loans, asset utilization loans, and HELOC or cash out loans. I'll also do a super quick overview on VA loans, since I know one of you were specifically interested in options for veterans. So as a mortgage broker, I have access to a wide range of lending programs and partners, which means I can really customize solutions for each client. And this is important because not everyone has a traditional W-2 job. I work with business owners, self-employed borrowers, gig workers, 1099 contractors, and other folks whose financial situations don't fit that standard mold. Clients like these often need a more flexible approach, and that's where being a broker really makes a difference, and that's why I really enjoy being a broker. And in contrast to the big banks that are often very cookie cutter in their approach, they have strict criteria, and if you don't fit it, then you get an X and you get turned away, even if you're financially solid. So by having multiple lending options, we have programs that can work with your situation, whether that's, using equity from a current home, leveraging your assets, or qualifying based on your real income rather than what shows up on your tax return. So the takeaway is that specialty loans exist to help people with non-traditional situations succeed in today's market. And having a mortgage broker who understands a lot of these options can really make a difference in finding the right program for your goals. Okay, so let's talk a little bit about the Bridge Gap Loan Program, which is designed for homeowners who want to buy a new home before selling their current one. And one of the biggest challenges in real estate right now in this is timing, right? You don't want to sell your home too early and end up in a temporary rental. And you don't want to buy a new home before selling and feel stuck carrying two mortgages. Plus, many buyers struggle to qualify for a new loan if their existing mortgage payments are counted against their debt. So this gap loan solves that problem. It allows you to access equity in your current home to use as a down payment on your new home. It excludes your old mortgage payment when qualifying, and it gives you 6 months to sell your current home. And the best part is during those 6 months, you don't have to make any mortgage payments or pay interest on your old home. So it really takes the stress out of timing your move. So here's a real life example. I'm actually working right now with my clients, Sarah and Mark, who wanted to move to a bigger home in Seattle in their neighborhood. They found their dream house, but they hadn't sold their current home yet. So with a traditional mortgage, they would have to wait and move into, or they'd have to wait to sell, or they'd have to move into a rental temporarily. With this GAP program, they were able to pull equity from their current home for a down payment, exclude their old mortgage from their debt calculation, and now they have 6 months to sell without making payments on the old home. Then they're even using $35,000 from the loan for cosmetic updates, which should help them be able to sell at a really great price. So the takeaway is that these GAP loans are perfect for buyers who want some flexibility and a smooth transition from one home to the next. And it allows you to move confidently without worrying about kind of timing and being caught between two mortgages. Okay, next I'm going to touch upon bank statement loans, which is a type of home loan designed for people with non-traditional income, like self-employed folks, freelancers, business owners, gig workers, etc. So unlike a traditional mortgage where lenders rely heavily on W-2s or tax returns, bank statement loans look at your actual cash flow. So lenders usually review 12 to 24 months of your bank statements to see how much money is coming in and how steady your income is. And that makes it much easier for someone whose taxable income looks very low on paper because of, business tax deductions or other write-offs. But this allows them to qualify for a mortgage. And the trade-off is that there is sometimes these loans come with a slightly higher interest rate or bigger down payment. But for many people, it's worth it to access financing when traditional options won't work. So I actually had my client Jeff, who is a solo attorney running his own business law practice, and he earns a very solid income. But because he deducts expenses like, rent for his office, marketing, legal research tools, etc., his taxable income on his tax returns looks much lower than what he deposits in his bank account. So with a traditional mortgage, qualifying would have been practically impossible. So when he came to me, he wanted to buy this beautiful townhouse and he was rejected by the bank. However, we used this loan type and we looked at his actual deposits over 24 months. And by focusing on his real cash flow rather than his taxable income, Jeff was able to purchase a home that fit his situation. So this loan type can be a really great tool that gives flexibility for anyone with non-traditional income. Okay, so now let's talk a little bit about asset utilization loans. So these are loans that allow you to borrow money using your investments as collateral, like stocks, bonds, retirement accounts, etc. So again, unlike traditional mortgages that focus heavily on your paycheck or W-2 income, lenders using this program look at the value of your assets to determine how much you can borrow. So this can be a really smart option if you don't want to sell your investments to pay cash for a house. Selling investments can trigger taxes, or you might miss out on market gains. So an asset utilization loan allows you to purchase a home while keeping your portfolio intact. So here's a real life example. John is a semi-retired professional who has built up a strong portfolio of stocks and retirement accounts over the years. He no longer needs to rely on a full-time salary, which can make it hard for him to qualify for traditional loan. So with an asset utilization loan, John was able to use the value of his investments as collateral to borrow money for a vacation home. He also had the flexibility to renovate his current house, all without having to liquidate his investments or pay taxes immediately. So the takeaway here is that asset utilization loans offer flexibility for people with significant assets, but their income stream might not look as great. And this really opens up opportunities to access funds when the traditional methods don't work. Okay, so for folks, I get questions sometimes about home renovations or building an ADU. That's a fairly, common thing right now where people maybe want to look into this if you're staying in your current home. So there are a few ways to finance it. You could use a HELOC, which works as a credit line against your home equity, letting you borrow as needed, kind of like a credit card. A cash out refinance replaces your existing mortgage with a bigger one and gives you the difference in cash up front. Or if you already have a great interest rate on your first mortgage, you could get a second mortgage, which gives you a separate lump sum loan with fixed payments. Each of these options can fund an ADU construction or home renovation, and the best choice kind of depends on your timeline, budget, and cash flow. And with the right approach, though, you can add value to your home, generate rental income, and even and create extra space, all without having to pay out of pocket up front. Okay, so lastly, I'm going to just touch briefly on VA loans. So this loan type is only available for veterans, and it's one of the most flexible loan types out there. The biggest perk is that there's a zero down payment option, which means you don't need to save even 3% or 3.5% to buy a home. Plus, you have no private mortgage insurance, which helps keeps your monthly payments lower. You do need to still qualify with your income, though, but VA loans offer competitive interest rates and flexible credit requirements, making it easier to qualify than many traditional loans. Closing costs are also limited, and in some cases, the VA can help with refinancing later. There are a few things to watch out for. There is a VA funding fee, which helps the program keep running, but that can usually be rolled into your loan. And also, not all properties qualify for VA loans, so your home must meet certain requirements. In short, VA loans are designed to make home ownership more affordable and accessible for those who have served, but it is important to work with a lender that will walk you through all of these steps so you understand these details and there are no surprises. All right, so in conclusion, whether or not you're a first-time home buyer or a seasoned homeowner, there are mortgage options to fit your unique situation. And the key is to be prepared, to know your budget, and we can explore your loan options and programs that make sense for you. And with the right guidance, buying a home can be much less stressful. And in today's market, still offers a lot of opportunities for those who are looking to make a move. So feel free to reach out to us to discuss your home buying goals and custom solutions. Thank you. Okay, I'm going to hand it off to you, Reba.
Let me get my audio on. Thank you. All right, so I am going to swap out and do the share on my presentation. Okay. All right, can everybody see that okay?
Oh.
Was that a yes?
Yes.
Okay, great, thanks. All right, so I need to move a couple things around because I still also have the attendee list over here. So, all right. So obviously I'm Reba Haas with Team Reba, Remax Metro Eastside. And along with what was just covered by Joanna, we're going to be talking about from the real estate perspective, what is going on so that people can have good strategies for what they're trying to accomplish as it relates to the real estate side. And again, kind of like what Joanna was saying, all the people who had actually expressed an interest in participating today had a wide spectrum of needs and experiences. So I'll try and cover as much as I possibly can. But to get started with all of that, I want to talk a bit about what the market is looking like. Okay. And now, of course, as soon as I'm trying to move my slides forward, is anybody seeing my slides actually move forward? Because it doesn't look like it's.
No.
This is where Zoom
It's on the same page.
Yeah, that's what I thought. Okay. But you can see everything okay.
Yes.
Oh, here we go. Now you
There
can
we go.
see it?
Now we can see.
Okay,
Yep.
months of inventory is what we
Yep.
see. Okay,
Yep.
fantastic.
Mhm.
Hopefully I didn't just, yeah, okay, great. Apparently there was a lag, sorry. Okay, so I'm going to start off with what have I been talking about a lot this year? And what that is what does this market look like in comparison to past markets? Now, this months of inventory for 2025 is a chart showing it's condos on the left, single family homes on the right. And what you're going to see is, so the lighter green is from last year in 2024, and the darker green is what's going on this year. And I'm also going to give some perspective as to prior years, because we've had a pretty interesting last 5 years, because just 5 years ago, what did we have? COVID. And of course, during COVID, what happened? We had some of the lowest rates we'd ever seen. Joanna showed that in her chart earlier, which also meant we had a skyrocketing of buyers out there and a wild market. And in mid 2022, interest rates went up significantly. And when we say significantly, just in comparison, not necessarily super high rates as compared to all time, but because they went up significantly and that impacts payments, suddenly everything softened, right? And so the months of inventory has been shifting over that period of time. But what I want to show specific to our market area, and this is generally for Washington, it's not all parts of Washington, because of course, certain marketplaces you have macroeconomics and microeconomics, but we are closer to employment centers. We actually still have what I've been calling a mixed market for the last 3 years. Because in mid 2022, we saw the shift, we saw inventory go up, we saw the number of buyers back off. And honestly, between mid 2022 and mid 2024, we had what I like to call the fear factor in real estate. And I always say when there's fear, the answer is no. And what that turns into then is people not choosing to move forward on buying property, because they didn't really know what was going to happen, and they were kind of in a wait and see mode. And there was this hopefulness that we might eventually get back down to some of those super low interest rates. And the reality is those super low interest rates came because of a massive crisis. Every time we've had drops in interest rates, it's because a massive crisis is going on economically in the world and the United States. So if you look at this months of inventory, specifically over here on residential, you're going to see these numbers here, even on the 2025. These, in middle, this is May is where a lot of inventory starts to come on market. We still had less than 3 months of inventory. And that is pretty outstanding for the entirety of the MLS, because that's about 26 of 37 counties in the state. And so having this little of inventory is why we have a mixed market, meaning you have about 20-25% of the houses are still selling for over asking price or within the first week. There's another like 50% of homes that are selling within the first month or so, probably around their asking price. And then there's another 20-25% that are selling below their asking price and are maybe on market for a bit longer. And that might have to do with price or condition or both, or some other kind of special factors for that particular type of property. But generally speaking, I'm showing King, Kitsap, Pierce, and Snohomish counties here. And you can see all of them are, and these are like the major kind of metro area here. You can see they're all under 3 months. In fact, often close to 2 months. That is still considered in the real estate industry a seller's market. But because inventory did go up, there are still opportunities. And that is one of the things that, like, Joanna and I have worked with several clients together this year where we've gotten closing costs, whether that's from the asking price and taking it off that, or maybe we add some to the asking price to ask for it back. We're getting more inspection items covered during transactions, whereas, back in 2021, that you were buying it as is in many cases. And sometimes people were doing it without even taking an inspection as part of their process. So we're in a situation where inspections are very normal now. Appraisals, people aren't having to like guarantee that they cover gaps if there's an appraisal issue. There's a lot of benefits about what this mixed market is providing for buyers. And as someone who also lists property, I have to have those conversations with sellers and tell them you need to be prepared. And it depends on what kind of property it is. But especially if it's something that might appeal to a first-time home buyer market, or someone who's maybe it's a heavy FHA or VA area. Oftentimes we're asking for those closing cost credits. I have one down in Tacoma right now where because it's in Tacoma and it's very close to JBLM, very commonplace to be, asked to do some kind of closing cost credit because of the cost of the fees that go into a VA loan. So, we have those conversations all the time. And this is part of the story that we have to talk about of why is that? Because I can tell you as a comparison, I have counterparts in areas like Florida, Colorado Springs, Colorado, Phoenix area, things like that. They're having a completely different story about what's going on in their markets. Many of them have declining markets, declining prices, longer time of time of market. So it's really very much, you've got to look at what the local micro market is. And sometimes you even have to get as narrow as the neighborhood, because some neighborhoods might be more popular because of maybe a school district or, whatever the thing might be. So it's always worth it that when you're looking at any of this, that you talk with somebody who can read the tea leaves, so to speak, and figure out kind of what's going on and what you can kind of anticipate, because we have data inside of the Northwest Multiple Listing Service that we can mine to help us really understand any particular market area and what's happening with product types, locations, things of that nature. Also, what we've been seeing is that the median sale prices continue to be pretty strong. Like I said, Colorado Springs is seeing some negative, they're getting depreciation instead of appreciation, but that is rare. Our marketplace, when we see median, I also want to point out, someone might immediately look at this for King County and be like, oh my gosh, the prices are starting to drop. Twofold answer with this, because it's not necessarily the truth, because when you're talking about a median price, it's just that half sold for more and half sold for less. It's not the average. So this number is impacted by who chooses to sell and what those prices of properties end up being. So it's still a good indicator of kind of what's going on, but it doesn't tell absolutely everything. This difference in King County in May of just over 1 million and just under 1 million, it's still averaging around 1 million. So, it hasn't changed much. Nothing that is enough to really get excited about, because also this is impacted by, with King County, again, looking at macro and micro, King County covers a lot of towns. So I can tell you for a fact, there's sections of Seattle where there's multiple offers happening and they're going over $1 million. But if I were to go down to, say, Federal Way, that's going to impact, because we've got $500,000 to $800,000, a little more common price point down there. So it's going to really impact what's happening here. And the luxury market also has softened, because as we've seen employment be impacted, particularly in the tech sector, some of the luxury market has actually softened. And so that's going to also impact what we see with this number here. So something that's new in the MLS also is that they are now tracking more closely what's going on in pending sales. And that helps us understand more about kind of what to expect coming up. And I find it fascinating because when we're looking at what is happening, so here it's showing that prices were up 0.6%. So again, even though that median number that I just showed in the last slide is showing maybe a little dip for, say, King County, overall in the MLS, there is some increase in what's going on with pricing. And you see this pending price of the list price ratio. So the pending price, they're showing that most of these houses are selling for their asking price. So they have this, you might see some at 98%, 95%, but maybe they're offset by some that are 105%. But overall, the average is most of the homes are selling for what they're asking for. This I also find fascinating because, again, when we have to talk to people about what can you potentially expect with what you're trying to accomplish, well, offers or multiple offers. So this is the percentage of properties that had multiple offers on them. And it's down just slightly from the full date range that I ran this, which is 1 year, but it's still 27%. This fully supports what I was just saying about the 20 to 25% roughly of properties are still selling for more than asking price or have multiple offers on them with escalation addendums. So it went from 11 to 9%, but that's still, around 10% of them have escalations, meaning they're going over asking price. Sometimes you'll have multiple offers and nobody's going over asking price. Sometimes they're all at asking price. Maybe you've got someone under. We had a listing in Everett recently where we had 2 offers. One was at asking price, one was slightly underneath. So, they can come in a variety of packages. But I think it's interesting that we're still seeing, if you've got a great property as a seller, you may still see, people coming in with multiple offers for you. Escalations, again, that happened. We just closed on one in Shoreline where there were multiple offers. Pendings with financing addendums, that is still the primary way that people are buying property. It's not just all cash anywhere. So you can see we're at 70, I think it's 73%. Pendings with inspections, again, like I said, a lot of properties still have inspections done. Now, I do want to note something that is not captured in this slide or this pending detail from the Northwest Multiple. Because when I first started seeing them tracking this, I thought, really, is it less 50% or less? And then I had to remember that over the last several years, because again, we have these situations with escalations and multiple offers and such. One of the reasons we don't see a higher percentage of inspection addendums is because there are still sellers and agents who are recommending to sellers that they get a pre-inspection done. So there are a lot of properties that the seller has provided that inspection in advance, and the buyers are accepting that and then waiving doing their own. So that still is impacting this here. And I will tell you that number is up since COVID, because during COVID, when everything was selling like hotcakes, and even sometimes when a seller didn't have a pre-inspection done, we got as low as 25% of transactions had an actual inspection on them. So, which is crazy. In my 22 years of doing real estate, that was an insane number, an absolutely insane number, because we always want to recommend that somebody have an inspection done or at least have received something that gives them information about that property. So pretty compelling info. So again, the snapshot is, the market is still doing well, but because interest rates continue to be relatively high, which means payments are higher than they would be if we were back to, 3 to 5%, people are, kind of holding back. There is lower inventory, but there is still moderate home appreciation. We're still seeing anywhere from depending again on your market area, 2 to 5%, which to me really speaks to buyers from the perspective of, if you keep waiting for rates to come down, in the meantime, the prices are still doing this. They're going up and to the right, right? And so the longer that you wait, the more expensive that property is going to be. And as Joanna mentioned earlier, a lot of people are really looking at how can I get in and just be prepared when rates drop? Because I have to say, prior to COVID, when we got down into the fours in interest rates, everyone was just beyond happy. And so when they got down into the threes, I remember I was still doing my radio show then, and we kept saying on air, we're like, we've never seen anything like it. This is, I mean, I know we're all tired of this word unprecedented right now, but it was unprecedented to go anything below 4.5%. In fact, when they got under 5%, we were kind of like, wow, this is pretty sweet. This is nice. And then COVID. And so everything kind of changed. And so unfortunately for some people, especially younger folks just getting into the purchasing market, they have a different perspective because they've never known other interest rates. And I tell people all the time, my first house in 1997, I was thrilled when we got 9%. And then several of my homes were at 7%. So the fact that I could eventually, refinance the house I have in Renton down to 3.32, I was thrilled. I have other houses at 4.5% and 5% that are investment property, which I still consider quite nice, right? Still better than what today's rates are. So, when you get that opportunity, yeah, heck yeah, go down and drop that payment. And the thing that we're also seeing, like I've seen some things online where people are talking about what's going on in the real estate market and saying, oh, that just seems ridiculous. Renting is a better thing. But I can tell you just this year alone, several of the single women that I've worked with, one of the reasons they were going ahead and buying for themselves was because what they did notice was, gosh, prices keep going up. Rates have been fairly stable. But the thing is where I'm renting continues to go up. But they don't get anything at the end of the day out of that. And several of them were like, man, the corporate, behemoth that has my building, like clockwork. One gal had been in her place for 5 years and 10% rate increase every year. Think about that. A 10% rate increase every year cumulatively is pretty huge. And she's not getting any equity at the end of the day. And so she just decided to invest in herself. And, we made sure that she didn't have too much payment shock. But, we just had a closing earlier this week with a mutual client with me and Joanna. And it was the same thing. Even though she has a little bit of payment shock, what she knows is that she is creating an asset for herself that for however long she's going to own this, it at least will pay her back at the end of the day. Whereas she just keeps renting, it won't. And then, of course, strategic buying is more important than ever. So because we have this mixed market and you look at every property for its particular, details and what that seller is trying to accomplish, what are you trying to accomplish, we have to get super strategic and really think, what is our goal with this particular property? Because sometimes we are going to get that better price. Sometimes we are going to get those closing costs. Sometimes we get both. Sometimes we're getting, other benefits through the transaction that meet the goals of a buyer. So we really dig into what you're trying to do and then go forward from there. And sometimes it has to be property to property because sometimes it's just, how do I win? We just had that on two of my very recent sales. It was less about, can I get a great deal? Versus I want that property for a very specific purpose and my hold intention is for a long term. So I'm willing to go into that fight and, beat out the next, best offers. And, being really strategic has paid off. Our clients won each of those situations. So there's first time buyers, move up, move down buyers, kind of depends on usually where people are in their stage of life and what they're trying to accomplish. And then, of course, we have what I call accumulator buyers. because it can be investors, or maybe you're buying multiple vacation homes or whatever the thing is for what you're trying to do. But maybe you're someone who's just like buying and holding with no intention of selling anytime soon in the future. The move up and down buyer is one that we've worked with a lot lately because people just, yeah, they held off for a few years, but life circumstances just move them into a place where they're like, I've got to do it. So we'll cover a little bit of each of those. So first-time buyers, challenges and concerns there are affordability with the higher rates, comparison to rent. We do understand that in many cases, someone is going to be paying more for a mortgage payment than they are for a rental. But we have to look at the whole picture. Do you get the benefit of, tax write-offs for anything, for, interest or any, taxes, any of that kind of stuff? Someone may have a limited down payment. We don't really always see that so much as a challenge because there's ways to work around that with different kinds of programs. To me, when I think of the longer term, what are you benefiting? It's worth looking at, well, what are you putting into it with the long-term hold growth on that? Because if we want to compare that, say, to stocks, if you're buying stocks, you have to put 100% of what that purchase is into that stock purchase. But with a house, you get the benefit of leverage, right? So whether it's that 0 or 3 or 3.5% down payment, that house is appreciating based on its value, not what your down payment is. So you get the benefit of this much more expensive appreciating asset over time. So sometimes it's kind of fun to go and take a look at what that looks like. And then people are a little surprised and go, oh, now I understand why this can sometimes be better than doing the stock market. I already talked about the monthly payment shock. I think the bigger challenge we've had for people who are doing the first time buy is that they're just in analysis paralysis, because there is that like, oh God, is now the right time? And the reality is, like I've already mentioned, the prices in our area, like you do want to pay attention. Do they start to drop? But right now, they continue to grow. And I do also want to point out, though, that during the Great Recession, we only had 3 years of down values. Anyone who actually lost value during that window of time, if they stayed in their home, and I am a perfect example of this. My current home in Renton that I have, I bought in 2007. In fact, I just had my anniversary. October 26, 2007 was the date I closed. And yeah, the first 3 years I lived there, the value dropped significantly. However, I knew I was a long-term hold on that house, and the payment was more than fine for me. So I just held on to that whole time. And that house is now worth double what I paid for it. So as long as you can maintain your long-term vision for that and not panic, or, hopefully you don't have situations that cause a problem for you, the long-term hold has always been beneficial in real estate, because out of the last 70 years, only 4, of which 3 were during the Great Recession, only 4 of them had price drops. And I mentioned, we can always run stats on different areas. So we can show you what a particular market area has been doing over time if you really want to dive into it. Smart strategies. We've talked about these through what Joanna was covering: buying down the rate, asking for seller credits. For people who don't have a lot of cash, looking at down payment assistance programs is another option. Focusing on starter homes. People have kind of adjusted themselves to, like, back in the very low interest rate days, maybe you got a bigger, better house, but people are starting to recognize, there are these things called starter homes out there, and they still get you working up the ladder of, long-term appreciation and growth, and you can always shift into something else. And then, of course, the rent versus own comparison, we can always run that for somebody too. The move-up buyers, or even if they're downsizing, the big challenges there are, I need access to my equity, and Joanna's already covered a couple of the options of how you can do that. Timing that sale and the new purchase is a big challenge. So again, we talk a lot about like, what are you trying to accomplish? Do you have any deadlines? What are the strategies that we can use? Because people are afraid of double payments or homelessness, or having to move twice. That's another thing, because it does cost money to move. We walk through all of the different ways that you can manage these processes, and we try and figure out what's the best option for you and what's our fallback option. Because maybe for somebody, they're willing to, if they get their house under contract, then they're ready to just like get out and go try and buy something right away. Like maybe we do a rent back situation. You close, you have access to your money, and now we have an up to 59-day rent back situation, and we're out looking. But if somebody is concerned that the right house won't come up, we may have a double move strategy. There's a number of different ways that we can try and work through that, but we just have to walk through what you're capable of and what you can manage and deal with on stress. Move up buyers, again, bridge options, buying contingent. We are seeing some properties doing contingents, selling with the lease back, like I just mentioned. Sometimes the time of year can also get you better terms for something like that. Summertime's a little bit harder for some folks. So whether it's in a season that has a little bit less deadlines around, say, like kids needing to start school at a certain time or something like that, that can help. Talking about your home equity and or investments. Like we've had a lot of people doing different versions of that too, because maybe they've got investments that can allow them that money in between to buy first and then get out of the house, and it's easier to sell that other home. And then definitely work with somebody who's done this before. There are a number of agents who aren't as savvy around some of this, and so they may not be able to advocate as well for what your needs are in that arena. People who are doing investment purchases, the concerns and challenges that they run into is, becoming a landlord for the first time, concerns about juggling multiple properties. How am I going to manage all this? Am I going to manage it? Am I going to get property management? Am I buying commercial? Am I buying residential? What is it? And then financing that, while you're still in the house that you're in, because some people have the idea of wanting to invest, but don't realize that maybe they don't have the debt to income ratios that would allow them to do it. But if you do have the ability from an income perspective, you can do lines of credit, cash out refis, using rental income to qualify. There are some loans out there that will make it less about your debt to income ratios, but more about what the property can actually support payment wise from the rent. Some people are doing the house hacking, meaning accumulators might be, there's a lot of younger people who are getting together with their friends, and one person might buy it and then a bunch of their friends end up becoming the renters. So there are some loan products that kind of work around that. You can follow another strategy that many people have, which is, and I can't remember, Joanna, if you covered this or not, but when you buy a residence, you typically get a slightly better interest rate than if you buy an investment property, because, we're all looked at as yield and risk to lenders. So there are some people that their strategy is, I'm going to buy a house to live in for a while, and then later on, I'm going to buy another house, and then I'm going to convert this one into a rental. And that's totally fine. As long as you've lived there for a year or more, the lenders don't care. So for many people, that is a way to do it and to get the benefit of lower interest rates at the beginning. And now if you try to refi later on, it's now an investment unless you move back in. And then you've got to be there for a period of time, and you have to guarantee you'll be there for a year. But, those are some other strategies that people have with converting to investment property. And we always recommend talk with your CPA too about whatever your strategy is going to be, because there are tax consequences for all of these, and you just want to understand how it works for you. So just kind of summing up, what's available to everyone. Some of these strategies that we were talking about, first time buyers, buying down rates, seller concessions, they don't have any of this because they don't have another property to sell. But move up people, they have most of these things to be considering. Rental income is not an issue there, but for the accumulators, for sure it is. I like to say there's one of the warnings in real estate is that, or not warnings, I should say, one of the negative things that's talked about in real estate sometimes is people are like, well, of course, you're a real estate, you're always going to say it's a good time to buy. And I get that. There are some agents who say that no matter what. And of course, that's because they don't know how else to sell anything. My thought is, as someone who's done this for 22 years, but who's also owned property for over 30 years, you just have to have what your strategy is. I would have loved to have been buying during the Great Recession. Other people were terrified to get involved in buying real estate back then. I would have loved to have been able to buy. The only reason I wasn't able to buy more back then is because I'm actually technically considered as self-employed. And so self-employment loans, because those were what were abused during that time window, went away for 5 years. If that had not been the case, I would have bought up as much property as possible. That's actually when Warren Buffett got into the real estate industry and started buying houses in bulk. Joanna mentioned it. He said, when everyone else is fearful, that's when you strike. And that's what he did. And so if you're in the position to do that, you can. If you know what your strategy is, you can actually do very, very well. But even during the time of, it's, multiple offers, what have you, again, you got to know what your strategy is. You can't just go blindly into it. People who do that do poorly. But if you know what your strategy is, or you can strategize with somebody on that, you can do very, very well over time. And you have to know what those goals are. You have to understand what your financing is. And there's a lot of people who just really don't know enough. So it helps when you get some good partnering with professionals. Have a good agent who understands what's going on, who isn't just an order taker, working with a lender who understands all the products and the nuances about what your needs might be for what you're trying to accomplish. If you're trying to get into multiple properties, definitely be talking to your CPA about what the benefits are or the tax strategies behind those things. And then, I can't say it enough times, be strategic, not emotional, because warning, it's going to get emotional anyway. Even when I bought my last 2 properties that were investment properties, I got emotional. Not because I didn't know what I was doing, but when you're buying, close to $1 million worth of property, you suddenly are like, oh, ouch, okay, I hope this goes well. Right. And, even after I bought those 2 properties that I just mentioned, one of them did go bad. And it got emotional. But longer term, the ability to step back, work through the issues, and figure out a new direction. I'm glad I didn't get overly emotional and get out of that property when many people told me to walk away from it. Because honestly, right now, it's the one property that, even though it's not fully been renovated yet, but it's about to be, that one has had more appreciation for the area where it's at than any of the other properties I own right now. And so long term, still the right move for me, because this is a property I bought to become a vacation rental, which eventually will be my long-term retirement home. So I'm staying with my strategy. I might have had to make some, shifts and changes along the way, but it's still the right choice. And I don't regret it at all. And I've still got a great interest rate on it. So I'm glad I bought it when I did in 2021. So just know it's going to get emotional. We work through those things. We talk about what are going to be the things that are going to put your biggest stressors on you. And then we work to try and make sure to minimize them as much as possible. And then that's it. So, all right. I am looking at our attendee list. I'm going to stop my share. And one of the things I'm noticing is Leslie is not here anymore. I don't know at what point she left. So I don't think we're going to have a Q&A, Joanna.
No, unless you want to ask me questions, and I'll ask you questions.
We can always do that. But I don't know, like, is that, Angel, let me ask you, since we're, because this is, do you want me to pause recording right now?
Yeah, you can end the. Yep.
Okay, so
Thank
that's
you.
everything that we've got for today. Angel, I'm going to pass it up back over to you.
Awesome. Thank you, Reba. And a huge thank you as well. And for you, Joanna, for sharing your experiences and expertise. And thanks to all of you for joining today's No-Fluff Homebuyer class. We hope you found this class useful, empowering, and a solid step forward in your home buying journey. Have a wonderful day, and we hope to see you at a future session.
Yeah.
Bye for now.
And I would encourage that if you have other questions, feel free to reach out to us after the session.